possible to purchase a house with little to no money down? I know we all know about wholesaling and how you can basically get in there with no cash or no credit, but we know you're not necessarily closing on deals when you wholesale. But with these strategies or creative financing, you're literally able to purchase properties with little to no money down, guys. I kid you not. So in this video, I'm going to break down 3 creative financing strategies to the best of my ability because I'm not an expert, but I'm going to break them down in the most simplest form so you guys understand how you can actually close on deals with little to no money down. So stay tuned. What's up, guys? My name is Lillian Chukwueze. If you're new to my channel, welcome to the family. I drop multiple videos every week about real estate, entrepreneurship, and investing. So if any of those topics interest you, subscribe to my channel and hit the notification bell so you don't miss when I drop the next video. So let's get into it. So what in the world is creative financing? I know this term gets thrown around so much. I mean, like I said, we all know what wholesaling is. It's a very simple concept, right? But what exactly is creative financing? I originally learned from the GOAT, Ron LeGrand. I mean, this dude knows his stuff, right? So I actually came across wholesaling and I immediately saw creative financing. I got hooked on that. And luckily I was able to get a personal mentor who is now Brian Irgebu, which is a beast when it comes to creative financing. So let's get into it, guys. So there's 2 ways to buy houses, as we know, right? There's cash, which is wholesaling and actually purchasing with cash, right? And then there is terms. So there's cash or terms when it comes to buying a house. Now, terms which is basically ways that you can provide more solutions to being able to pay sellers more money over time. So what Ron says is basically this: if it's my price and it's my low cash offer, then it's your terms. But if it's your price, then it's my terms. So if you want to agree on me paying your price, then it's got to be my terms, which is basically me being able to structure paying you that price over a certain period of time. So keeping it at a very basic level, if I'm paying cash, then I'm probably going to be paying less. But it is a lot faster. It's a lot faster, more convenient process for you. But if I'm paying with terms, then I can pay you more. So when it comes to me and my offer strategy and what I do when I talk to sellers is I always give a cash offer first, and then I give a terms offer. So we know what a cash offer is. You know, you can pay cash, you can get under contract for cash and wholesale it to another investor. But when you're purchasing with seller financing or owner financing, it's a little different. So now when it comes to terms, one of the ways is to purchase with seller financing, or also known as owner financing. That basically means rather than the seller getting paid off full upfront in cash, he or she basically agrees to sell you the property over a period of time with little to no money down, and they carry the balance owed in the form of a note. So basically in this case, the seller is being the lender for you on his or her own property. They're basically the bank. And this is usually done with free and clear properties. So, you know, if they have a mortgage, that's a whole nother strategy. But if they have a free and clear property, you can definitely structure a seller financing option for them. For example, let's say a seller agrees to sell your property for $100,000. And rather than paying cash or borrowing money from a lender like a bank to pay the seller off the full $100,000, instead the seller agrees to seller finance you that $100,000 over, let's say, a period of 10 years. And in this case, as I previously mentioned, the seller is now the bank, and they are lending you the financing for this house. So let's say instead of giving them $70,000 in cash right now to close in the next 2 or 3 weeks, you're offering them $100,000, obviously, which is more, over a longer period of time. And ownership would still transfer to you as normal as if you were to go to a bank and purchase the property. You still get the same ownership, but the loan stays in the seller's name. So you're probably asking, why would a seller want to do this? The main reason is because typically they get a higher purchase price for their property. So instead of that $70,000 in 2 weeks, they get $100,000 over 10 years or whatever the term is that you guys agree to. Another reason why they would do this is to get that monthly income. If the property was already being rented out and they're used to getting that income, or if they want to generate monthly income, this is a way for them to do that because you would be paying monthly to purchase this house. And that monthly income essentially comes without any headaches to them because you're taking care of the taxes, the insurance, the maintenance and repairs that come with purchasing the property. Now there's 3 things you have to consider, which is basically the down payment, the monthly payment, and the length of the term. But I don't want to get too deep into that, guys, because I'm not sitting here saying that I'm an expert. I'm far from an expert. I'm actually still working on closing my first creative financing deal. But I have a great mentor who I've been learning so much from very closely. I told you guys earlier, Brian Irgebu, and if you want to learn that, I would highly recommend learning it from him. He has a program. You He needs to give me an affiliate link because I vouch for this program all the time. But I would say that I'm very knowledgeable in this subject field. So I'm just giving you guys what I know and what I'm actually putting into practice at this very moment. Now, the next strategy when it comes to creative financing is purchasing subject to. Now, I know you guys heard this as well. I mean, you're probably asking, what is subject to? Subject to is basically, it's another form of seller financing, except the property has a mortgage. This literally means you're purchasing the property subject to the existing finance. So rather than purchasing the property and paying off the existing loan, essentially you are going to take over the loan. You're not going to assume it, but you're going to take over the loan and those monthly payments that the seller has to pay, and basically make those payments on behalf of the seller. So the existing finance stays in its place. It does not transfer over to you. You are not assuming the loan. So you're probably trying to figure out what the difference is. The difference between assuming the loan versus purchasing it subject to the existing loan is that with an assumption, the buyer essentially agrees to become personally liable for the debt that's in place. So basically that means that if you're assuming the loan, if you default, then it's on you. But when you purchase subject to the existing loan, the seller remains primarily liable for the note and the mortgage. So if you default, technically, it's still on the seller. So basically that just means that there's more risk in it if you assume the loan and there's no risk to the seller. But if you take it over subject to, then the seller has a little bit more risk and it's less risk for you. But there's basically ways to structure a subject to deal without much risk to either party. And there's certain things that you can do, such as incorporate a promissory note, just making sure, which is basically just extra protection, for the seller, saying that you're definitely going to be paying this note. On top of that, you can, set up a third-party servicing company where they can see that you are making these payments. And I know Pace Morby does like a 30-day guarantee to where, like, if you don't pay within the first 30 days, like, they get the property back right away. Haven't used that strategy, but definitely you can put in place a promissory note and a third-party servicing company to be making these payments. Now, again, you're probably asking, well, why would they want to do this? Why would a seller sell it to you subject to? So when buying subject to, as I mentioned, you are taking over the payments that the seller currently has. So they're basically able to walk away from the property. So the seller is relieved of making any of the loan payments, the insurance, the taxes, and pretty much all the other costs and responsibilities that are associated with ownership, such as, the maintenance and the repairs. So you're making monthly payments to a seller without them having to do much except sit back and collect their money. And sometimes this is a very helpful option for people because they want to get out from underneath these loans and they really don't have any way to do so if they have little to no equity in the property. They essentially can't sell it because they wouldn't have enough equity to sell with a real estate agent or even to a wholesaler who needs equity to, conduct that type of deal. Now, a way that I'm able to basically transition into this pitch, as I told you guys, I offer cash first to basically set the baseline of, what I'd be able to pay cash and get them out of the property quickly. But if that's really not a fit for them, I say something like this. Mr. Seller, I could probably get you more money if you're willing to give me more time. Because as I told you guys, this is a strategy where you're able to pay more money over a period of time. Or you can say something like, hey, what if I can give you a steady stream of income without the headaches of being a landlord? That's something that gets a lot of people's attention. Or if they have a mortgage, you could say something like this. What if there's a way I could take over your payments and get you cashed out later down the road? That's a really good one as well. Now, the final creative financing strategy that I want to go offer are lease options, or a lease with an option to buy. Now, a lease option is basically a contract between the owner and a buyer to lease or rent out the property for a certain period of time. And at the end of that time, or at the end of that rental period, the buyer basically has the option to actually purchase the property, usually for a predetermined price. Now, the option gives the tenant the option to purchase, but is not necessarily obligated to purchase. So basically, it binds the seller to sell the property, but it does not bind the buyer to buy. There's no obligation for the buyer to buy. They just have that option, hence the name lease option. And lease options are very common, actually, when a buyer basically wants to buy a property, but they don't necessarily have the credit to qualify, for traditional financing or traditional loan for a bank. They pretty much need time to improve their credit, save a little bit more money, and just improve their overall financial situation. So a lease option pretty much assures the buyer, it gives them some type of assurance that they have the first right of refusal to buy the property. And it gives the seller rental income from a more committed tenant who will eventually or hopefully buy the property at the end of the lease. Now, as always, you're probably asking, why would the seller want to do this? Why would a seller lease option their property? These tenants basically take care of these properties more than a typical tenant because they are going into this purchase, or they're going into this contract looking to actually purchase this property at the end of their lease. So they're looking at this house as their potential permanent home. So naturally, if you know you're going to live here for a long period of time, you're probably going to want to take a little bit better care than, you know, a typical tenant who's looking to get out in the next year or so. And being able to sell on a lease option, you can sell for more money because people are basically willing to pay more money for flexible financing, because it's not as available out there as, you know, conventional or traditional financing from a bank. But, you know, using the traditional financing from a bank, there's so many more restrictions and so many more requirements, you know, when you go that route. And the great thing about leasing a property out with the option to purchase is that if somebody does not purchase the property, you still get to keep their non-refundable option payment that they give you in the beginning of the lease, which is usually about 5 to 10%. So if you're selling a property for $100,000 on a lease option, you might get about a $5,000 or $10,000 deposit. And if they don't buy at the end of the term, guess who still has that non-refundable option fee? You do. You still have that $5,000 or $10,000 that they gave you in the beginning, because they put that down with the option to purchase the property at the end of the term, but they didn't. So that answers the question of, well, what happens when they don't buy? You just get somebody in there. You just get somebody else in there to essentially give you the same amount of money down, and you have another, you know, committed tenant. So basically, guys, I just want to fully disclose that I'm not an expert. I'm actually in the middle of 2 deals that I'm looking to close on with creative financing. Specifically, one that'll be a sub 2 and another one that'll be a seller financing. So I'm not sitting here to say that I know all the answers to everything, but hopefully this gives you guys a good breakdown of what, you know, creative financing options that are out there and what strategies that I've learned about, you know, to be able to implement in my business. I honestly really love creative financing. I found out about wholesaling first, but right after I found out about creative financing, I was pretty much mind blown. And I just have been rolling with it ever since. I really want to build out a creative financing portfolio, so this is really what I'm focused on, although, you know, wholesaling is always an option. But, you know, when it comes down to building a business, I want to be able to build, you know, passive income streams, and creative financing is definitely the way to go when it comes to that. So hopefully this helps you guys out. Hopefully it gave you a foundational understanding. And if it did help you, please like the video, subscribe to my channel, and hit the notification bell so you don't miss when I drop the next video. I talk all about real estate, entrepreneurship, and investing. So if any of those topics interest you, definitely hit the notification bell so you get alerted when I drop the next video. Until then, guys, stay safe and stay blessed. I'll see you later.